Good afternoon, everybody, and welcome to this week's macroeconomics analysis session. Here with David, and sitting alongside me on January the 29th today is Jeff Saffer. Welcome, Jeff.
Thank you, Dave. Hello, and hello, everyone.
Let's get underway. First and foremost, as always, our disclaimer: the content of today's presentation or any other Elite Wealth presentation does not constitute a recommendation, nor does it take into account your investment objectives, your financial situation, nor particular needs. Before making an investing decision based on the general advice presented in any of our presentations, please consider whether that advice is appropriate in light of your financial circumstances or seek further advice. All right, the week in view, the lady on the screen there, the Richie Beno lookalike, Janet Yellen. She's obviously had a fair bit to do with the maintenance of very low interest rates in the US for a period of time now. Raising rates for the first time, I think it was back in December, was it, Jeff?
Yes.
Which was obviously had been factored into the markets since the beginning of the year. Obviously, the US market in particular has been extremely volatile and has given up a fair bit of its gains from last year. Or when I say gains, it really didn't gain much last year at all. It's certainly given up some gains that it did make over the previous 18 months in particular. The week in review, Jeff, a couple of bits of information here that we'll go through. I think importantly, CPI on last Wednesday, the figure there.
Yeah, look, CPI came in, I've got there the trim mean, so you'll often hear they call headline inflation or just the official inflation numbers.
Yep.
And that's what a lot of the news stories pay attention to. What I pay attention to, what the RBA pays attention to is trimmed mean. And it takes out things like food and oil, which have volatile prices. So we've seen headline inflation has been really low because obviously oil prices have been slumping, dragging inflation down. But that's not really an indication of overall prices. So once you strip that out, trim mean inflation is a little bit higher, 0.6 for the quarter, which is sort of bang in the middle of the RBA's target. So if you were to times that by 4, it's 2.4%, and the RBA's obviously got their target 2 to 3%. So look, inflation is low. I think inflation's going to be low in Australia for some time, but if that ticks up at all, then the RBA will definitely stay away from any more rate cuts.
Yep. So what's the biggest impact on inflation? What's something that could happen in the economy that might drive inflation in an upwards direction?
Look, it's not necessarily likely at this point in time, but something to keep an eye out for is that wages growth has been really, really slow. The slowest levels that it's been in a couple of decades, actually. So if that starts ticking up, and the unemployment rates come down a little bit, the employment market has firmed a little bit. If we start seeing that, and I don't think that's happening in weeks or months, but maybe later this year, wages pick up a bit, inflation will pick up on the back of that.
Yep, good.
The other thing in Australia, business confidence was down. I predicted last week that it could fall. We also saw consumer sentiment fall as well. So they both got a bit of a bounce after the Turnbull vote, and then that's kind of worn away a little bit. Everyone was all really excited about him and thought he could fix the country in a matter of weeks. It didn't quite happen that way, and everyone has sort of calmed down a little bit. But the big economic news this week was in America. Well, until about an hour ago, that is. The Fed meeting, they had their rate decision. Of course, they were going to leave rates on hold. As usual, paying attention to the language. Janet Yellen said that they'd noted that financial markets risks had increased. Obviously, the US market's fallen and China's slumping, etc. But she did sort of stick to the story that the US economy is still chugging along fairly solidly, and she said that further rates will be gradual. But I think the market was hoping for an admission from the Fed that they were a lot more worried than they were a couple of months ago. Markets are in meltdown. The US economy's not looking so good. We're going to put the handbrake completely on rate rate rises. And she didn't reveal that, didn't come up with anything like that. So the market kind of had a mini panic after that, because they were saying, oh, if she's not changing her mind, these Fed members are really committed to continuing to raise rates.
Yep.
So in contrast to that, about an hour ago, the BOJ came out with their monetary policy statement. I did announce probably for the last 3 or 4 months of last year that I was expecting Japan to come out with more stimulus, and they didn't. Pretty much when I'd given up the ghost on it happening, they've surprised everyone a little bit, and they've actually cut the official cash rate to negative 0.1%, and the implications of that is that any bank, financial institution that holds money with the BOJ will actually have to pay
double charge for the privilege.
Exactly, for handing their money over. And why would you do that? Well, to discourage that sounds terrible. Why would I hand money over to someone and have to pay them a fee for that? So you wouldn't want to do that, and so the idea is to stop the banks leaving their money with the BOJ. They want to encourage lending. They want to encourage cut savings rates, basically from just about zero anyway, and encourage everyone to spend.
Yep.
Go around, spend some money, get inflation moving, stimulate the economy. It's pretty.
So is that going to encourage banks to lend to businesses?
Yes.
For that purpose?
Yep.
Yep.
And so the businesses will borrow money because the banks are encouraged to lend it, and then businesses will spend money and get things ticking over. It's unprecedented for Japan to have negative interest rates, but it has happened in other countries. The Swiss have got negative interest rates, have had for about a year. If I'm not mistaken, I think the Swedes have got negative interest rates. The ECB is probably not that far off from doing it themselves. So it's pretty drastic, but it has happened before. And as well as cutting rates, they also maintained their asset purchasing program. So they've been buying bonds and ETFs and anything they can get their hands on. So we saw the Japanese market jump up 3 or 4% in a matter of minutes, and then in a matter of minutes gave that all back.
Yep.
The dollar yen jumped a couple of percent, and then gave back most of that. So that's this also a secondary effect. You announce this kind of measure, like I said, to encourage lending, but also to push your currency weaker, push the yen down, and then that will help the exports. So Japanese goods become more competitive compared to European and American goods. And other regions as well. So, but interestingly, and we'll keep an eye on it tonight, that initial move has just sort of reversed itself.
Yeah, it's interesting. I think we'll reflect on this over the course of the weekend to see what impact it has on broader markets as well. Certainly, one thing of the last few weeks is that the Japanese market has really been sort of leading a lot of the other markets, particularly the US market. So I think it's something that's certainly a bit of a bellwether for the US. What we might do now is go through and have a bit of a look at our local markets here, and just for a little bit of a change, just going through the ASX 200, but also some of the sectors within the ASX as well, just to provide a little bit of a macro view, particularly from the fundamental side of things. Just taking some of your expertise in that area, Jeff, because everything from a technical point of view that we look at on a chart, there's a story behind it, and obviously. When you're well qualified in that aspect of it, then you can provide a bit of context for what we're looking at here. The ASX 200, for a long time, we've been down in either very high risk or extreme. Market volatility has been picking up of late, so that the range, the upward and downward movement on day-to-day, week-by-week basis has been increasing. And hence our little green shaded area, if you like, is above its longer term sort of moving average there at this point. I have made note before that on a couple of webinars that this level through here is pretty key. These old support levels are now being tested. You've got to remember they're not paper thin levels. They tend to be more zones than anything. If we are to rally, then I'd expect a rally to move back up towards this sort of 5,200 level if we can get that far. Over in the US, if we just have a quick look by comparison. Similar sort of news here. We're down in extreme territory, and again, the volatility has been increasing quite considerably. You can see the movements downwards, and this longer-term moving average that we've talked with the members on the weekly webinars is now looking like it's going to start acting as dynamic resistance. So these are big points of supply moving on the way down. I've drawn one in there for future reference just to see whether or not we can rally back up to that level. At this point, we're certainly not out of trouble at this point in time. We're really testing this support zone through here at the moment, and if we can't hold convincingly above that level, it's not a good sign. I'll just provide a little bit of context on that as well. So if I just scroll out, if we happen to sort of breach these levels where we are at the moment, you'll see that we've tested sort of 2014 levels, and if I might put this on a weekly chart. Just to have a little bit of a look, and what I'll also do is I'll just pop on there for a tick, just a 63 period moving average, just to show you how well this moving average works as a support resistance zone, if you like, over the longer term. Now this is pre-GFC territory, and I can scroll back even further, and you can see that during that really good bull market that we had, how well it respected that 63 period moving average. Once we closed below it and came back to retest, and we couldn't close above it properly, we really capitulated, and that was all during the GFC. From that point, it took a while for the markets to recover and convincingly stay above our longer term moving average. But when they did, it held up quite well, particularly this is the US market in particular. But since then, you remember back in August last year, we've tested, we've broken down below those levels. We managed to pop our head just back up above them. And if I just zoom in there a little bit now, you'll see that we've broken below these levels, and the test for us is if we can rally back up and close above those. It's not looking like we're going to do that anytime soon, but if we happen to rally up and fail at that level, then I'd expect similar sorts of things to happen as happened back here. It's certainly and once we get down to those levels here and we can't, through all the efforts, make it above those levels, then the whole psyche of the market starts to change and everything starts to focus on the negative side. So that's just a little bit of a view into what could happen. I'm not saying it will, but the markets tend to have a habit of repeating themselves, particularly when we're getting into time frames from lows to highs of sort of 6 to 7 years time. We're probably due for a fairly major move more to the downward side than the upward side. Just want to go through the Australian sectors at the moment, and Jeff, I might just ask you to comment on some of these. We might just go through and then perhaps make some comments on individual stocks, not too many or anything like that, but just some examples, etc.
Ladies and gentlemen, your attention please.
Welcome back, folks. If you happen to hear a little bit of beeping in the background and wondering what that noise was, we just had a fire drill here at work. So we're all safe and sound, so thanks for your concern. Just looking here at the sectors here, Jeff, the consumer discretionary there. I just want to zoom out a little bit and have a look historically how this sector has performed over the years. Obviously, during a bull market, the bull market tends to lift a lot of ships. During the GFC, market really fell down. Certainly not been a strong performer over the years compared to some of the other sectors. Having said that, it's just marginally holding its head above water at this point in time, Jeff.
Yeah, so this is an interesting one, and the zoom out was quite telling for me. Most of the markets had a bit more of a V shape, so obviously it fell during the GFC, and then it sort of bounced back relatively strongly. The discretionary sectors struggled a lot more, and there's a few reasons behind that. So the Aussie dollar's been pretty strong in recent years, so instead of going out to your local shop, your JB Hi-Fi or something, you jump on the internet and you order something from Amazon or eBay or Apple, etc. Online.
Yep.
And we've had, and as well as that, I think the Aussie retailers have had it pretty good for a number of years, and in the last handful of years we've had some international chains come in, so the supermarkets are now, that's admittedly more staples, but just for part of the discussion, Coles and Woolworths had it pretty good for a number of years, and now they're dealing with Aldi and Costco.
Yep.
Myer and David Jones had it really good for a number of years, and now you've got H&M and Zara and wherever else you go shopping for clothes. Not my thing too much, but so that's been an element. So the retailers have struggled even post GFC, but they've spent quite a number of years, last few years, really trying to sort themselves out a bit, investing more in like online stores, becoming a bit more competitive. And now that the Aussie dollar's fallen back to around 70 cents, we're sending less of our spending dollars overseas and going back and spending
More on
local
shops.
again.
Yeah. Okay.
So that's why it hasn't really performed that great. Hasn't had a big bounce back, but it is holding up not too badly.
Okay. Good. Well, that all makes a lot of sense. That's a pretty scary looking chart from a technical point of view, Jeff. The energy sector, for a long time now, it's been really in bear market territory, and particularly over 2015, that large plunge through September there, through here. A lot of countries around the world seem to be putting more and more oil into the system. Just recent talk that the Russians might be thinking about reducing some of their supply to try
and the
prop up-
Saudis
and the
as well.
Saudis try and prop up the price for a while. I mean, who would have thought that a few years ago, Jeff, there were futures contracts for $150 a barrel in oil, and that was probably around about this point here.
Yes.
And from a technical point of view, this is actually very significant that we get these areas of support through here, and once broken, we quite often get a retest of those previous levels, and if it doesn't hold at that point in time, we get this capitulation, and we've really had that in recent times. So the question is, how much further downside pressure are we going to have before we get a bit of a relief rally to the upside? So that's the question, the $1 million question. Comments on the energy sector in Australia, Jeff?
Yeah, look, it's an interesting one. There's been a lot of talk in the media. Look, oil prices, like I said, back in the day, was $150 a barrel. Last week, there's a few different types of contracts for oil, and all three of them were sitting below $30 a barrel, and everyone's blaming it on China slowing down, which I think is a bit. Which is a piece of the puzzle, but I don't think it's the main picture. A lot of it has come from supply. So, in particular in the US, they've, and this is quite common, you get a commodity price booming, everyone goes, back when oil was $80, $90, $120 a barrel, everyone starts up massive projects. Big energy projects take 5 or 6, 7 years to get online, and then everybody's projects start up at the same time. They start pumping oil, and there's more oil than we need. And that's been, for me, oil is more of a supply side issue than it is a demand side. So, I mean, what you need is you obviously need for the supply to come off, which possibly we've seen the first few signs with Russia and the Saudis deciding to cut back, and then but a lot of companies, if they're still making money, aren't going to decide to stop pumping oil. But many companies will, at $30 a barrel, go, we can't make money at these levels. We need to stop. They scale back, and then prices start going higher. But it'd be nice to also see some demand increase. But for me, it's much more of a supply side. Look, I see some value in some energy stocks around here. How far can oil prices go down? I can't say. And the energy companies can definitely go lower than where they are. But I don't necessarily see oil being at $28 a barrel in 3 years, 4 years, 5 years. And I think if it's back up to $50, $60 a barrel, I think you'll see the energy companies 50% higher than where they are now. But it's quite a long-term, very patient view. That's not a trade.
Absolutely. All right, and there's our financials, and again, obviously, a lot of people would be familiar with this particular sector. Banks being a large part of a lot of clients' portfolios, particularly longer-term investors. And again, you'll see the banks rewarded people really, really well through pre-GFC times, and certainly supported our index for most of that way through. GFC time really fell off very, very quickly. a lot of sideways movements. Took a while for the financial sector to sort of get a bit of momentum building up, and then it finally sort of through 2012, and that's really when our market started to move up, and obviously, banks, financial institutions being a large component of the index, you can see that reflected. Recently, again, a bit of a telltale sign. First time we've sort of broken through, tried to retest what was effectively a dynamic support zone, is now starting to act as dynamic resistance. So that's a little bit of a concern. We've got some core levels at the moment that sort of really need to hold up. I wouldn't like to see us fall back down to 2012 levels where we came from. I've got just the 4 banks up here, Jeff, just to get a little bit of reflection on what this sector's doing at the moment. CBA is probably the one that's holding up the best by comparison. You can see it's only just started to fall below its longer term moving average and retesting at the moment. NAB by comparison is much further along, if you like, in a progression to the downward side. I'm not saying that CBA is necessarily going to do the same. Obviously some fundamentals and things that it plays with each of the banks, which I'll get you to elaborate in a moment. WBC, Westpac, certainly it's been well and truly under its longer term moving average for a while. It looks like it's almost sort of bottomed out to a certain extent. I might just zoom out a little bit and see where we are. You'll see it's had a much more sort of checkered history, if you like. Certainly, around that sort of $30 level seems to be a fairly strong support zone for it. ANZ, by comparison, is well on the way on the downward side, and certainly, it could fall down to the $20 level or even a little bit below potentially. CBA, really, I had a look at before. There's NAB. CBA certainly holding up a lot better than the other banks. Is there anything that might have an impact on the banks this year, Jeff?
Yeah, look, probably the biggest things at play, and you mentioned obviously the bank started rallying in 2012. It was pretty much almost the day, late 2011, the RBA cuts interest rates for the first time in this cycle, and investors start thinking, I'm going to go and chase yield, and they started buying up the banks and chasing the dividends. So the banks, probably what started this retracement last year,
Yep.
was an analysis of the financial sector.
That's right.
Came up with recommendations that the bank should raise more capital, basically make themselves safer,
Yep.
and essentially make themselves less aggressive, and that was going to curtail growth and restrict sort of earnings capability. And so the banks also raised fresh capital. They sold new shares, and there's talk going around at the moment that they might have to raise even more this year and or cut their dividends. So either of those would definitely place a lot of pressure on the banks.
Yeah, absolutely. And that's the area that you're talking through there, Jeff, this sort of around this area here where, the capital raisings, etc., big impact to the downward side. And if there's anything that like that on the horizon, then, you could expect similar sorts of movements across that particular sector. Just moving on to, sorry, that's the bank area there. I'll just go back to the sectors. Healthcare. Again, this has been a fabulous sector. Even pre-mining boom, it was a terrific sector then. A bit sideways during the during the GFC. Actually held up reasonably well by comparison with the broader market. And I'd say that probably over the last 20 years, if you'd had some health stocks and just even hung on to them, that you probably would have done pretty well. Stocks like Ramsay Health Care as an example, and a number of other ones. Are any sort of themes happening in this, Jeff? Why is it that healthcare is so strong?
Yeah, look, two themes. I mean, number one, healthcare is very defensive. So obviously, if the economy is struggling, you might not go out and buy a new TV, you might not buy a new car, but you're probably still going to pay your hospital bill if you break your leg. So from that perspective, it's obviously very defensive. Another thing to take into consideration is that most of the big players, things like CSL, Cochlear, Ramsay as well, have less so Ramsay, but have most of their operations overseas in the US and in Europe. So they and a lot of them report in US dollars.
Yep.
So they're making profits overseas, they're bringing those dollars back. As the Aussie dollar goes down, it makes their profits in Aussie dollar terms higher. So that's one thing that's definitely helping them at the moment.
Sure. Okay.
And on top of that, the population's getting older and a bit more frail, and spending more and healthcare costs are rising all the time.
Yep, certainly. Materials. So that's typically your mining sector, big component of that. And again, you'll see that every time we've had a rally back up to its longer term moving average, it really hasn't been able to hold those levels with any conviction, and it's a real telltale sign that these are areas where the bigger institutions are looking to divest themselves of funds in those particular materials related stocks. And it's just been like that all the way down. Is there any light at the end of the tunnel, Jeff? Because obviously, there was a time when the materials sector was great and everybody had BHP and they had, Fortescue and they had Rio and, a number of other stocks in there as well. Is that ever going to happen again?
At some point, yes. Look, the markets move in cycles, and if anything moves in boom-bust cycles, the most it'll be the mining sector. Certainly when they have lean periods, it can be... commodities can be in bear markets for significant periods, and in bull markets too. So once things do pick up, the materials sector could definitely rally for a number of years on end. When exactly is that going to happen? It's obviously very difficult to predict. What I like to do is, when I look at a sector, I look at the economic trends and factors behind that. So when I'm looking at mining stocks, I look at commodity prices, I look at what Chinese imports and exports are doing, I look at Chinese factory activities, and pretty much all of those are still pointing the wrong way. So it's getting to the point where I think there's some value in the miners, but there's not a lot of point jumping in whilst they're still going down, and everything suggests that the near term is still pretty negative. But look, I think at some stage, definitely at some stage, we will see a tick up in these things, and that will give us an indication that we'll get a recovery, and any pop up in the chart is more than just the little bounce we saw in January last year or June the year before. I think
that's well worth noting that whilst there's probably some value in some companies, the question is, well, how long is that going to take for that value to be appreciated by the market and for the market to get behind it and really start to push it in an upwards direction convincingly. And whilst we've had little movements up like this only to be sold down by the broader market, what we're really looking for is price to move back up, consolidate above our blue line and really show some strong positive price action towards the upwards side, and then obviously using our relative strength indicators, etc. They're the sorts of things that help. Will certainly help time things from a technical point of view, but also appreciating the fundamental backdrop as well. The industrial sector. Don't know too much about the stocks in the industrial sector, Jeff. From a personal point of view, obviously pre-GFC, very very. Deserving, if you like, or rewarding in terms of what the sector did on the charts. Really fell out of bed though once we got into GFC type territory. More recently has been sort of moving upwards and respecting its longer term moving average. It's starting to a bit more price action now, starting to hover around that, which is to be expected given the broader market. What are some of the stocks that make up the industrials?
So the industrials is a little bit of a motley crew. It's in a sense, it's almost the stocks that don't fall into the other sectors. But the way I like to look at it is companies that provide services to businesses. So you get it's a whole range of things like manufacturing companies, companies that sell what we call capital goods, so large purchases that aren't something that's bought over the counter, to services companies, media companies, a bit of everything there. It's in the old days, you'd think of it, you'd have your mining stocks and your industrials, what I'd call sort of everyday businesses that typically supporting, selling goods and services to businesses rather than consumers.
Okay. So what is it that's maintaining, at least for the time being, some degree of support for this particular sector compared to the finance sector, which is clearly moving over, and finance being such a big part of our economy, compared to the industrials which might be feeding some of those businesses?
Look, it's hard to sort of give an answer because there's very different companies in the sector. You've got your engineering companies, and some of those engineering stocks are struggling because they're weighted towards the mining sector.
Gotcha.
Some of them are weighted towards the property development sector, and they're doing quite well. Look, there's no sort of silver bullet, but certainly just generally low interest rates and low oil prices as well are really helping the bottom lines in these sectors. And business confidence has been reasonable over the last 12 months. So you put those together. I'd say those are the main factors, but it is a little bit more specific in this case.
Okay, cool. Consumer staples, so that's what normally fits into there. Is that things like your Woolies and Coles?
So your supermarket chains and food stores, etc., food brands. So look, this has obviously been dominated, like you said, by Woolworths, Wesfarmers. Although Wesfarmers is a bit of an interesting one. It's got Coles, but it's also got coal, energy, and Bunnings and insurance until recently. So Metcash as well has been struggling for a number of years. I mentioned before that those supermarket chains have had increased competition from international players. So it's still a pretty difficult space.
Okay. And again, over a period of time, performed really, really well. A lot of people made a lot of money. Really struggled for a period of time. Then obviously during easing of interest rates, those sorts of things started to perform a little bit stronger. More recently, though, really starting to, struggle every time that the price moves back up. We're starting to get a bit more supply happening.
And this is something, I mean, if you can look at the chart, it had its high in 2013. So it's been falling for 3 years now, whereas most of the market has only been falling for 9 months. So this is something that's not just caught up in the market; it's got its own problems.
And certainly, again, from a technical point of view, when you're running your scans, etc., these are sorts of things. The relative strength, what's happening with those stocks compared to the broader market, is really important because it's really helping to point or highlight those stocks that are suffering, if you like, or where there's more supply than what there is demand. And certainly, if you're after capital growth, then you've got to have more demand than supply. Taking the dividend aspect out of it as well. Don't know whether we've got any more sectors to go through. One more there, the telecommunications sector. This is largely dominated by Telstra.
Correct.
So have heard of this called the Telstra Index. And obviously for the last few years that's been climbing, as has Telstra, and it's a chart very similar to Telstra, isn't it? Where there was a time when who would touch Telstra when it was it just seemed to be on one massive downward run, and then eventually it turned around, and clearly again you can see using this longer term moving average getting some nice strong closes above that longer term moving average, and then just starting to see a series of higher troughs along the way, and that's continued for a number of years and lots of dividends along the way with that particular stock. Just more recently falling below, coming up to retest. It's really a bit of a battle round here at the moment to see what's going to happen. I think that's just about it. I thought the last one was the last one. Utilities. Utilities, Jeff, covers.
Yeah, so these are your gas companies, energy companies, pipeline companies, etc. They're very defensive and they tend to pay not a lot of growth, and they pay nice dividends. So that's the trend you see there is very steady. And they've obviously held up very well amid the market carnage, which is to be expected. So.
Yeah, that's for a lot of years too. That's from 2011. The broader market really didn't get going until well into 2012. So certainly, I guess the defensive nature of this, the quest for dividends, etc.
It's very sensitive to interest rates is a big one.
Okay. Right, folks, well, that's just about it. We just need to go through and have a quick look at what's coming up next week. So I'll just skip through. Oh, so I've pulled up the wrong slide there. Beg my pardon. In China next week on Monday, the Beijing, I think is how you say it, Jeff, the manufacturing PMI. How much of an impact is that going to have on the markets, given that everybody's a bit worried about China?
Yeah, look, definitely important. I mean, it's probably, for me, it's probably the most important indicator out of China, and this it shows how factories in China are travelling, basically. So I pay a lot of attention to this under normal circumstances. Certainly when everyone is in meltdown mode over China, it takes on greater importance.
Yep.
It's been pretty weak for the last sort of 6 months or so.
Yep.
And I think it'll still stay below 50, which is an important line in the sand.
Yep.
But if that can hold up okay, then I think you could see the markets rally for even a week on the back of that.
Yep.
Manufacturing PMI data out of the US as well would be interesting, considering that we've generally seen weak data from the US.
Yep.
And obviously the monthly employment numbers as well.
Yep.
Trade balance numbers as well in the US. In Australia, we've got a rate decision next week.
Yep.
Of course, it's virtually certain that rates are going to be on hold.
Yep.
I'd be surprised if the RBA springs much out of from left field in terms of their statement.
Mm-hmm.
They have said recently that inflation's probably under control for the next 1 to 2 years.
Yep.
It'd be interesting to see if the latest inflation numbers have any impact on them whatsoever, but I think it'll just be business as usual for Glenn Stevens and the RBA.
Okay. And just that rate announcement in
the Eurozone as well.
for the English folk over there. Retail sales coming through on Friday. All right, folks, thanks for listening to us this week. It's been a fairly long session. Just wanted to discuss a few things that we hadn't previously, just a bit of sector-by-sector breakdown, a bit of a look behind some of the fundamentals driving those particular sectors. Obviously, it's going to have a little bit of an impact on what might be in your existing portfolio, but also important to appreciate that element of relative strength from a technical point of view at the very least, fundamentals aside. So that's it for this week. I look forward to catching up with those of you in the ETC on Monday morning for our weekly analysis session. That's it for me, so I'll say goodbye.
And it's goodbye from me. Thank you.
Thanks for listening.